Hello, everyone. Hope I'm live here. Um, Good afternoon to everyone in Hong Kong, Asia, and good day to everyone else joining um, elsewhere. I am Kaushik Saha. I represent TrueRisk Capital. TrueRisk Capital is a Los Angeles-based hedge fund that manages uh, basically strategies that try to fit all kinds of risk appetites, whether it's growth or capital preservation, defensive. Um, and we use algos to basically automate a systematic research-based process. And so the strategies we offer are basically trend following strategies that are popular on the S&P 500 index. We offer US equity long short, and then we offer a volatility strategy. Um, and these typically target anywhere from, say, 10 to 25% annualized return with a respectable Sharpe ratio. And so basically, we expect allocators like advisors, institutions, even high net worth individuals to basically look at them on a standalone basis or combine them with their existing positions in their portfolio to create a mix. So today I'm going to talk about um, how to build a winning model portfolio. And I'll talk about the strategy one ought to take given this environment that we're in, and how to create an allocation that can withstand the volatility that is to come and survive basically all the excesses of the past. So I'm going to share my screen because I have quite a detailed presentation. And so for the next 35 to 40 minutes, I'll go through the presentation. And after that, I'll probably save about 5-10 minutes for questions. So how to build a winning model portfolio, allocation, execution, and strategy. First of all, disclaimers, as we are regulated by the Commodities Futures Trading as a Commission. What we present today is not necessarily investment recommendation. So today I'll break it up into two parts, the presentation. In my second half, I'll of course talk about how to build the winning portfolio, but I want to first focus on the current state of financial markets, because that is what's going to drive my thinking behind what to put inside a portfolio so that it can weather basically the downside and the volatility to come. So when I talk about the current state of US financial markets, which impact global financial markets anyway, I'll talk about economic financials, valuations in general, technicals, and sentiment. And then in building a winning portfolio, we know that markets are overvalued after I cover this first half. And then I'll talk about reasons for portfolio protection and then justifying an allocation to hedge fund strategies. So people think when they hear about hedge fund strategies, they think about aggressive growth and high returns, and that is not necessarily the case. One can take certain hedge fund strategies, and then apply them in a defensive manner so that it produces returns which are unique and different from returns in other asset classes in your portfolio, and so it counterbalances it. That's the focus of today's presentation. So current state of US financial markets, if there's one chart that I want to show to explain where we are, it's basically that the entire market the financial markets and the economy has been completely driven by financialization. And it has driven inequality and polarization. Right now, it stands at 6 times the size of US GDP, 6.5, and it's coming down. And the average in the past, before 1980, was 3. So it's at least double. And so you can see from 1980 onwards, there's been a steady financialization. And next, we'll look at what's been driving it when we look into economic economic fundamentals. So if you look at economic fundamentals, you see that over a 200-year period, as the US economy has grown, what's been a 3 to 4% GDP growth rate has been coming down slowly, obviously, because of the law of large numbers. The larger the economy gets, the harder it is to produce higher rates of return. And so now we are at a roughly 1.5% average growth rate. And it's a struggle. And the last 10, 15 years was decent at 2%, very acceptable. And it was driven by increasing issuance of debt, shown in the black line going up. So again, over here on this chart, you see from 1980, when GDP growth dropped from 3 to 3.5% all the way to 2%, it was compensated, or it was energized by an expansion in debt and an expansion in credit to fuel GDP growth and to boost GDP growth. And now, of course, ever since Biden's come in and post-COVID, because of the shocks that the economy has faced, we are seeing rising sort of stresses in the economy. And so we have to be mindful as investors, as growth slows, what can happen to returns after they have been boosted by loose monetary policy. So you saw in 2000, we had the dot-com bubble. And then before the dot-com bubble, we had about 26 years of real returns that were near zero. So, investors' portfolios on an inflation-adjusted basis didn't grow. Then we had the dot-com bubble, and then there was a crash, and then we had a 2008 housing bubble, and we had another crash. And the equity market, the S&P 500, again, in terms of real returns, had 13 years of zero returns, after which COVID saw another expansion of the balance sheet to levels where we are today. And so we have to ask ourselves, what's going to happen? How many years of zero returns will we face as a result of the Fed becoming active and creating quantitative easing? So basically, we can see that here the Fed has been increasing the money supply, and what has happened in increasing the money supply is it really hasn't, it has helped grow GDP at its trend rate at best, but what it's done is beyond that, it's basically grown basically an excess and created bubbles initially in housing and dot-com, and now in pretty much every asset class. And basically, M2, which is a measure of money supply, the Fed accounted for almost 1/3 of M2 after 2008, and that has increased to half of M2. So that is all loose money trying to find some asset to go into, which is why all assets are overvalued, which is the case I'm making. And the Fed going forward now has decided to reverse course because of high inflation prints and drain system liquidity. And basically there are at least 10 rate hikes projected, which will clearly hurt the economy. So over this period after COVID, the real economy, when you look at the grassroots level, post-COVID, high wage workers got their jobs back, but low wage workers, basically had a 21% drop in employment levels. And now we have stimulus payments that are past us. And so there's nothing to stimulate the economy when the Fed raises rates. Let's look at valuations. We see that, if you look at PE ratios, basically we are at 2 standard deviations above normal. And the Shiller cyclically adjusted PE ratio or CAPE ratio is at just about 40, which is an extreme, very close to dot-com levels. And so on the right-hand side is a table by Goldman Sachs, which shows that all the corporate valuation measures, enterprise value to sales, enterprise value to EBITDA, price to book, whatever you look at, they're all in the 90th to 95th percentile. And so by all metrics, basically corporates are overvalued. So equities are overvalued, corporate bonds are overvalued, and basically there's money sloshing around. And so let's look at what earnings projections are for the S&P 500. You can see that ever since the Great Depression in the 30s, S&P 500 earnings have been exponentially rising, partly because of inflation. And people expect, that these companies will continue to produce earnings in an exponential manner going forward. And Q4, last quarter of 21, the S&P 500 earnings were $207 a share. Analysts are projecting $220 a share, shown by this dotted red line. So you can imagine how unrealistic it is to expect earnings to continue to go up when the Fed is tightening rates and draining system liquidity. So this is obviously going to, come back, snap back like a rubber band. And the question is how severely it'll snap back and how far down will it go, because that is what is going to affect valuation. So in the past, you can see post-COVID, these high, tall bars of earnings changes quarter by quarter. It's gone up mostly because of the low interest rate environment. It's gone up because of share repurchases by companies, low tax rates, accounting gimmicks. But what we are facing going forward is an inflationary environment, increased wage costs as a result of it, increased borrowing costs to companies. Biden has talked about increasing tax rates for corporates. On top of that, we are facing decreased demand. And so there's slowing economic growth. And so there will be a pressure on earnings going forward, shown here. And yet you can see the red dotted line, projected upwards, which is quite unrealistic. Now, this table shows how historically it's seen that analysts are consistently wrong in overestimating earnings by a tune of almost 30% on average. So you can see 2013, 14, all the way to 2021, on average, the miss in earnings estimates is basically almost 30%. That is, they're always optimistic. But ever since the Fed talked about rising rates, hiking rates, we see that Bank of America, for one, has come out and said, well, earnings are going to be, revised down, and they expect an earnings drop in the S&P of 0 to 10% by the summer. And there'll be rate hikes and tapering of bond purchases, which will drive it. We look at the guidance by the business management, the executives of S&P 500 companies, and they are also guiding down their expectations of their earnings. And you can see a couple of bars, pointing south over here that's circled. the level now that they're projecting is just 0.29 times compared to 4.85 over the past 4 to 6 quarters. So you can see how quickly sentiment has changed, and people are getting very cautious. And this is going to hurt earnings prospects going forward. It's going to be projected out, and it's going to basically hurt financial markets. Let's look at investor sentiment. Here you see, the Citibank panic euphoria model, and you can see the two blue bands showing average levels of euphoria and average levels of panic. And we are again at least 2 to 2.5 standard deviations outside in euphoria in terms of complacency. And so the general market, we're not talking about economists and strategists, we're talking about people in positions who run businesses that run the economy all over the country. They are still optimistic, and this will revise down, and that is what Citi is pointing out. So what happens, this is a stylistic sort of representation of what happens in a bubble. Initially, you have strong growth, and then it starts to turn around and dip. Let's call these equity markets. They start to dip because, say, the Fed is raising rates, and people go into denial. And then there's a slight bounce, and people think they're returning to normal. And then it starts to fall even more, and then fear takes over. And so right now, I think we are somewhere between denial and fear. And so we can see that if the Fed is too quick and aggressive and draining liquidity and trying to tame inflation, then we could have, what we've seen before in 2008 and in the COVID period, where, at such high margin levels and such high borrowing levels, if margin rates are increased, then there could be a stampede out of markets. So the point I've made is there will be stress in the market, in this quarter, in the coming quarters, and the only uncertainty is where will the market find its bottom. And when I say markets, I mean pretty much all markets, because no matter where you look, money has seeped into pretty much every market. Bond markets are overvalued just as equity markets are. Commodities are overvalued. Oil is $90+. Housing, real estate, infrastructure, you name it. If you're an asset allocator, where do you look to invest? Because typically, as an asset allocator, when you are investing, you're buying an investment, and you're taking a long position, and you're going long risk. And so pretty much everything you invest in, private equity, private debt, crypto, all these are risk assets, and your portfolio is invariably vulnerable to falls in each asset class as the liquidity is drained out. So I'll bring up the case that hedge funds are a solution. As I said before, you may look at hedge funds as an aggressive, approach to investing, but you can, in this environment, look at hedge funds as a defensive approach, because they produce unique return profiles. Absolute return strategies produce, return profiles that don't depend on market direction, and that is what I'll emphasize on. So here I'm making the point I just made, that relative asset class risk in a portfolio is cyclical, meaning when basically when people are putting money into the markets, markets go up, and so you have this upswing in a portfolio, And then you're at a juncture where the Fed is draining liquidity, and you have unprotected risk that will be normalized. And your goal is to make sure that this does not remain unprotected. You find some protection for it. And so you have to find an allocation that basically is an effective counterbalance. That is your goal in portfolio allocation. So here we look at basically the universe of asset classes that are available to an allocator. On the left-hand side, I talk about traditional asset classes of equities, fixed income, and cash equivalents. I won't go down into the breakdown of equities and fixed income subclasses. On the right-hand side, I show alternative asset classes. So there are three groupings: private equity, uh, liquid alternatives down here at the bottom, and then I have real estate and infrastructure here on the right-hand side. And within it, you find basically everything that you would think of investing in, from venture capital to growth equity to levered loans to private debt to emerging managers, infrastructure, natural resources, REITs. And here in the middle is what I want to focus on when you build your portfolio, and that are liquid alternatives. And these are mostly hedge fund strategies. The most popular among them is long short equity. There are global macro event driven strategies. Then there are currency strategies, commodity strategies, which are, trend following, as I mentioned, is a popular one. And then you have relative value strategies, and your volatility strategy could be a relative value strategy. So the unique properties about these strategies in this circle here is that they produce typically absolute returns. They have the potential to make money, as much money when the markets go down as they do when markets go up. So that's why I say that most liquid alternative strategies are pro and anti-cyclical. So when the market cycle is pointing down, it can behave anti-cyclically, and when markets are going up, it can behave pro-cyclically. Whereas all the other asset classes outside of this circle are all pro-cyclical, that are worrying allocators right now. So liquid alternatives, people may not have focused on it too much. Now is a very good time to focus on it. Why would one focus on it at this juncture? I'll point out that since 2010, liquid alternatives, allocation to liquid alternatives has grown from 4 trillion to basically about 12 trillion at this juncture and growing, so three times. And most importantly, down below, I show you what is the biggest reason that allocators give in allocating to these hedge fund strategies. The first biggest reason they give is diversification and low correlation of these strategies to other strategies in their uh, allocated portfolio. The next reason they give is absolute returns and all-weather return profile. So they realize that these strategies can provide positive returns in rising and falling environments, market environments. And so they have an allocation based on this reasoning. They realize, those that are seeking enhanced growth, they realize that these strategies can provide enhanced risk adjusted return. Some people, when they feel like the bond markets outlook is not good, and right now, with the Fed hiking interest rates, the bond market outlook is really not good. Um, Basically, they allocate to some of these strategies, and I'll show you why. There's a historical chart. And then market downside protection. people fearing markets as they do right now start to look into some of these managed futures, market neutral strategies, long short equity, options based strategies. So these are the main reasons why allocators have basically allocated 6 to 20% to liquid alternatives in growing numbers. So here I show you a chart of the S&P 500 since 1990, and we see that in periods where the S&P 500 has fallen, it's shadowed in green, we see that in these shaded periods, the S&P 500 fell by 27% in the dot-com crash and the housing crash. And over this period, these liquid alternative strategies or hedge funds outperformed equities by 27%. So equities fell, say, 45% in 2008. Hedge funds returned flat. In the 90s, equities fell negative 15%. Hedge funds gained 12%. So you can see that hedge funds outperform the S&P in bear markets. So that's one substantiation here we see. Next chart, we see that when in rising rates and environments, so here we see the 10-year Treasury yield. When the Treasury yields rise, when the bond bear markets, we see that hedge funds outperform bonds. And we see here in the 2004 to 2006 period, that it was about 3 years where bonds basically sold off. And so fixed income returned about 6% because, some parts of the yield curve probably did not sell off and kept steep. Hedge funds returned 28%. So hedge funds beat 10-year treasuries. So we can see on this chart that hedge funds outperform fixed income by 16% when treasuries are selling off. And then here we show as you increase an allocation in your balanced portfolio and you allocate more and more into liquid alternatives, your risk-adjusted return goes up. So on the right-hand side, you see a balanced portfolio of 60% equities, 40% bonds, with an annualized volatility of roughly 8.5% and return, expected annualized return of roughly 10.5%. As you introduce 10% liquid alts by reducing the equity allocation, your annualized volatility drops significantly and your expected annualized return goes up. And it keeps moving, it keeps getting better and better as you increase the liquid alts allocation. So, again, numbers are speaking a story, and the story is, these are, hedge funds are a diversifier into any balanced portfolio that you create as an allocator. Here, during crisis periods, let's see what happens, when the S&P 500 crashes during the housing crisis, during, September 11th attacks, Russian debt crisis, so on and so forth. When the S&P has fallen about 5 to 40%, we see that hedge fund strategies have produced positive returns. And this is a chart by Barclays Capital. So again, all these point to, one sort of narrative, and that is hedge funds are probably something one needs to look into when building this portfolio. So how having talked about hedge funds in general, let's take a look at some hedge fund strategies, that can basically fit, the criteria of providing all-weather returns. So this is what TrueRisk Capital does, and our strategies are, one of the more mainstream strategies. So it's a good representation to show. I talked about U.S. equity long short, and so that's the box you see in the middle. And so here, this strategy basically is implemented using machine learning algos that look at large alternative data sets, and it builds a portfolio of stocks, 100 stocks that are long, 100 stocks that are short, and rebalances the portfolio every month, and basically has a net risk exposure of plus 15% to minus 15%. So it's not market neutral. It's basically maintains a skew, slightly exposed. It maintains a slight market exposure to provide returns that are meaningful. So that is one example of a popular hedge fund strategy, and so in our portfolio is now focused on shorting very high beta stocks and being defensive value stocks, which are likely to fall less. And so if the bottom falls out of stocks, it is expected that this strategy will outperform. So when this is an example where this strategy can return positive numbers when the market is actually falling, because we've shorted the high volatility stocks. Another one is a managed futures offering based on trend following. So this strategy basically looks at momentum or trend of the S&P 500 index, and once it identifies a trend, it will follow the trend and stay in the trend for as long as that trend is sustained. And so if the trend is facing down, like if markets are falling, then it will use E-mini S&P 500 futures. So this strategy uses futures instruments on the equity index S&P 500, and it will short E-mini S&P 500 futures to gain when markets are falling. So that's your managed futures offering. We have a TrueRisk market volatility offering. This is basically a strategy that implements delta neutral or direction neutral option strategies that try to harvest option premium. So it's like an insurance market maker, and we are selling insurance to buyers of protection, basically people who want to protect themselves from uncertainty or volatility in the S&P 500 index between 1 and 3 months. So for these strategies, basically this strategy takes these delta neutral positions and tries to run these options to expiration and collect the premium from the options. And if the market moves in between, the strategy basically uses algos to delta hedge and reposition these delta neutral positions. And so it burns some of the option premium in the process, and so it produces smaller returns when markets are more volatile. So this strategy, being a market maker strategy, is basically selling risk and buying risk back in the market at the same time and figuring out a sweet spot. So these are 3 strategies I mentioned that produce absolute returns or returns that have unique profiles and don't mimic the profiles of overall markets. And that's why they're sought after. And in the future, we will produce a multi-strategy solution where we'll mix these strategies and come up with a balanced sort of allocation ourselves, a balanced hedge fund strategy. And so, what do you get out of these sort of strategies that are implemented systematically? You can position for rising and falling markets. They are highly liquid, so these strategies you can enter into your separate managed accounts or fund, strategy fund 1 month and leave the next month. There are no lockups, no gates, no penalties. We focus on market risks versus idiosyncratic exposure, market neutral positions, market downside protection. And since they have algo-based strategy implementation, it's very easily scalable. Uh, Basically, there are a lot of efficiencies to be gained. And here's another, since we follow a rules-based process, there's no emotion. There are a bunch of rules that are implemented in the algos, and you don't have to worry about me getting all anxious that the strategy is losing money, and so I change my behavior. So there is minimization of error, and there is consistency and transparency in the strategy. And our strategies are backed by a lot of research papers that you'll find on our website. And lastly, I will say that if you have a portfolio as an allocator that are mostly in fixed income or equities, you can use these alternative strategies as a core strategy allocation, or you can, like on the right-hand side, or you can actually switch out some of your fixed income allocation for a hedge fund allocation, or your equity allocation for a hedge fund allocation. So 6 to 20% is what we've seen in the past. So I'll leave this conversation by saying, if you want to avoid crowded mainstream markets, hedge fund strategies are the way to go. It's an upgrade from traditional trading techniques. You're using leverage, and you have the ability to go short. And so every investor should carefully consider their own unique needs and potential risks, involved in these hedge fund strategies. So with these strategies, I'd like to lastly say experience matters. And so if you find a hedge fund manager saying I've returned 50%, 60%, they're taking outsized risk. If you're looking to replace your equity allocation, then you should find a hedge fund manager that says my strategy tries to uh, calibrate its risk profile to that of the S&P 500. So you know that the returns will be S&P like returns, same volatility. And so it'll have its own unique profile, but it won't ever provide you 50, 60% returns. So it's important to find proven managers who don't promise you outsized returns. With that, I'll open it up to Q&A. And if you have any more, questions or comments, I can be reached at connect@TrueRisk Capital, or at this phone number. TrueRiskCapital.com is our website. And so if you have any questions, feel free to reach out. I can take some questions now on the chat. And if there's a speaker, I can also hear your questions. We have about 5 minutes. Any questions, comments? No questions? Well, then I'll take your leave. Hope this was informative and enjoy the rest of the summit.